Spurred on by US strength, the Australian market has rattled unconvincingly back towards its all-time high. But now we face some tests, including the current earnings reporting season. Will we see a fresh all-time high, or are we about to see some profit-taking? Before we begin, we need to let you know that any advice contained in this presentation is general advice only. So there has been some tech nerves recently. It started in the US, perhaps with Microsoft's report. They fell about 11-12% after their earnings report last week. And basically the market was going, all these companies are spending trillions of dollars on AI infrastructure, but are they actually achieving earnings growth from it? Are they actually creating products that they're able to sell? And it's really hard to say, to be honest. They do have growth in their underlying businesses, but how much of that is being driven by this AI spend? It's very hard to say, and probably it's a lot lower than expected. They were already growing quite nicely. They're growing because the US government's printing tons of money, and that's got to flow somewhere. But are these AI products that they're creating really adding to the bottom line? And so there's been a bit of nerves around that. There was a bit of selling in US technology stocks. US tech is still a bit of a way behind its all-time high, where the rest of the market, in the US is around its all-time high. So a little bit of uncertainty there. Here in Australia, Australian technology stocks have been sold off dramatically as well. Now, our technology stocks mostly aren't related to AI, and if anything, AI presents a threat to them. Still though, our technology stocks for a long time, they've been dramatically overpriced. And with a little bit of nervousness around those US technology names, we've seen a bit of profit taking, a bit of return to normalcy for the Australian tech sector. Still, they're extremely expensive. I wouldn't be buying them on a value proposition here, but they're certainly a lot cheaper than they were, 6 to 12 months ago. We're currently at the start of the Australian company earnings reporting season, and expectations are pretty bad for this earnings season. It's about to be, I believe, the third to fourth year of no earnings growth for the Australian market, and in that time, the Australian market's up, several thousand points, 2,000 points roughly, on no earnings growth. This has made our market the most expensive it's ever been, outside of, very short-term periods where earnings growth has been written down due to significant items. So I'm of course referring to COVID really. Even during the GFC, our market was cheaper than this. And even during the dot-com bubble, our market was cheaper than this. Most expensive our market's ever been. This was also the case last February. And what happened last February is we saw some profit taking on our market, just simply because the underlying reality of the listed companies in Australia is not being justified by the prices that we're seeing. Those prices are being spurred on, like I said, by strength in the US, by printed money by the US government, and that money has to flow somewhere, and it's flowing to risk asset markets. Still, I think we could see some stock-specific shocks, one-day drops of double-digit percentages on many companies reporting this season, and don't be surprised if we see that in some of the biggest names as well. The results are, in many cases, are very unlikely to justify the high prices. Despite that, and despite what I say, expectations are low, and that does mean that we could see some surprises to the upside, and in some cases, people will have positioned bearishly for bad expectations, and they'll have to unwind if the results are good. So we could also see some upside surprises. I guess my general point though is that more and more we're seeing the Australian company earnings reporting season become a period of sell downs. I'm talking about February 23, I'm talking about February 25, I'm talking about August last year. These were periods where we saw some pretty rapid devaluations. In fact, in the February reporting season last year, our market saw very, very substantial selling. I think it was over 1,000 points from peak to trough, more than a 10% correction. And admittedly, obviously some of that was with the Trump tariffs and that sort of thing. But the initial sell down, our first move of about 400 points, I believe, came with the earnings reporting season, and it came in advance of the tariffs. It came before the tariff news came out. So I do think that there's a lot of risk this season. it's gonna, our market in general is not really focusing on what's happening locally. They're not focusing on the local rate rises. They're not focusing on the local earnings, but they can focus on them for short periods. They can focus on them for, a week, a couple of weeks, a month, and this could be a period where we do that, where we focus on the local situation, which really doesn't justify the prices for locally listed stocks. So let's have a quick look at the charts for this week, guys. We can see the Australian market, it tested the 8,900 point level today. It failed at that level, and maybe we've got a very, very short-term counter trend starting to form. We did have an uptrend from our lows of November last year, but that uptrend broke with our strong downwards movement on Friday. We did see a big rebound on Monday, and that was driven by a US rebound on their Friday night session. They were also higher overnight, but even with those two bullish sessions, we weren't able to push back above 8,900, and now we've clearly probably seen a lower peak. We now might be forming a bit of a head and shoulders pattern. If that's the case, that could indicate further selling. To the downside, I'd be watching roughly 8680 here, right around where the 200-day moving average sits and the low of Friday's session. If we break below 8680, it could be on to about 8550. I'm just going to draw that support level in there. Let's say 8690. If we break below that, it could be on to about 8550, a pretty big drop following that. As I mentioned, it could be that we see a bit of selling if the earnings results this season are poor, and expectations are pretty low for this earnings season. All right, this is the US market, the S&P 500, and they also drifted off throughout the middle of last week, and they fell back to the pretty key support level at 6,800, previously the all-time high resistance, or roughly the all-time high resistance. They held that level as support, and they bounced back up on Friday. They showed a bullish bar, stochastic turned around, and again overnight they showed a little bit of a bullish bar. They haven't had enough momentum to break through 7,000 though, which is their own all-time high resistance level. So given that we've had an inline trough now, and given that they've really struggled at 7,000, I'm now starting to wonder if we're going to see a bit more sideways movement from the US market. If they do close above 7,000, that'll indicate further upside. But if they again fail at that level, we're looking at a bit more of a sideways move. If they break below 6,800 to the downside, that'll be a lower trough. We would then be looking for a lower peak, and that might indicate a period of profit taking and consolidation for US shares. Regardless though, for the time being, they still look bullish to perhaps a little more sideways, unlike our own market, which is starting to look a little bit more negative. So we'll wrap it up there for this week, guys. If you enjoyed this video, please click subscribe. Please click the like button. Let us know in the comments if there's any earnings report that you're watching for this season, and we'll see you guys next week.